Welcome to our advanced trading tutorial, where we'll explore sophisticated cryptocurrency trading strategies focusing on effective risk management, leveraging techniques, and the utilization of technical indicators, such as the gapped RSI. Whether you're a seasoned trader looking to refine your skills or an intermediate trader aspiring to elevate your trading game, this video has something for you. Today, I'm thrilled to have with me a special guest, Evan, who brings a wealth of experience and knowledge in the crypto trading space.
Thanks for having me. I've been trading for several years, navigating the volatile crypto markets with a deep understanding of the intricacies involved. I'm here to share insights that can help you structure your trades more profitably while minimizing risk.
Our objective in this video is straightforward. By the end, you'll have a solid grasp of how to set up trades with a favorable risk-reward ratio, effectively use leverage without falling into common pitfalls, and apply advanced technical indicators like gapped RSI to enhance your trading strategy. So let's get started.
When it comes to trading, risk management isn't just a buzzword. It's a critical component that can determine your long-term success or failure. At its core, risk management involves identifying, assessing, and controlling the potential risks associated with each trade. In trading, risk is inevitable, but how you manage it makes all the difference.
One of the fundamental concepts in risk management is the risk-reward ratio. This ratio measures the potential profit of a trade relative to its potential loss. For instance, a risk-reward ratio of 2 to 1 implies that for every unit of risk you take, you expect to make double the profit. This ratio is crucial because even if you win only a fraction of your trades, say 35 to 40%, you can still be profitable as long as your winning trades outweigh the losses. Let's break it down with a practical example. Suppose you decide to trade a cryptocurrency that's currently showing signs of upward momentum. You set your stop loss at a level where, if the price drops, you'll exit the trade to prevent further loss. This could be at a support level, or a point just below a recent low. On the other hand, you set your take profit at a level where you anticipate the price will move up, perhaps a resistance level or a recent high. In this scenario, if your stop loss is set at $50 below your entry price, and your take profit is set at $100 above your entry price, your risk-reward ratio is 1 to 2. This means that even if you lose on more trades than you win, you can still be profitable overall. Understanding and applying the risk-reward ratio to your trades is crucial to managing risk effectively. The key takeaway here is that you don't need to win every trade to be profitable. What matters is the ratio of your gains to your losses. By consistently applying a favorable risk-reward ratio, you can manage your losses and ensure that your wins keep you ahead. The key takeaway here is that you don't need to win every trade to be profitable. What matters is the ratio of your gains to your losses. By consistently applying a favorable risk-reward ratio, you can manage your losses and ensure that your wins keep you ahead. Section 2. Leveraging in trading. Leverage is a powerful tool in trading, but it comes with significant risks. Understanding how to use leverage effectively can amplify your gains, but misuse can quickly lead to substantial losses. So, what exactly is leverage, and how can it be applied to your trading strategy? Leverage allows you to control a larger position in the market with a smaller amount of capital. For example, using 10 times leverage means that for every dollar you invest, you control $10 in the market. This can significantly increase your potential profits, but it also amplifies your potential losses. It's a double-edged sword that requires careful consideration and strategy. The benefits of leverage are clear. You can make larger trades and potentially realize higher profits without needing to invest large amounts of capital up front. This can be particularly appealing in the volatile crypto markets, where price swings can offer substantial profit opportunities. However, with these opportunities come risks. The higher the leverage, the smaller the price movement needed to trigger a margin call or liquidation of your position. This means that even minor market fluctuations can have a significant impact on your account balance. Let's look at a practical application. Suppose you have $1,000 in your trading account and decide to use 10 times leverage. This means you can enter a position worth $10,000. If the price moves in your favor by 5%, you stand to gain $500, which is a 50% return on your initial $1,000. However, if the price moves against you by 5%, you lose $500, which is half of your account balance. This illustrates the high stakes involved in leverage trading. To mitigate these risks, it's crucial to use a risk management calculator before entering a trade. This tool helps you determine the appropriate position size and leverage level based on your risk tolerance and the specific trade setup. By calculating your potential risk in advance, you can avoid situations where a single bad trade wipes out a significant portion of your account. The bottom line is that leverage can be a valuable tool when used correctly, but it's essential to approach it with caution. Always ensure that you fully understand the risks involved and have a clear plan for managing those risks before applying leverage to your trades. Successfully setting up and executing a trade involves more than just clicking buy or sell. It requires a thorough analysis of the market, a clear strategy, and disciplined execution. Let's walk through the steps involved in setting up a profitable trade. The first step is market analysis. This involves studying the charts to identify potential trading opportunities. Start by looking at key levels of support and resistance, which are areas where the price has historically reversed or paused. These levels can provide clues about where the price might head next and help you determine your entry and exit points. In addition to support and resistance, consider using technical indicators like the Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is typically used to identify overbought or oversold conditions in the market. An RSI above 70 indicates that the asset might be overbought, while an RSI below 30 suggests that it might be oversold. Once you've analyzed the market and identified a potential trading opportunity, the next step is to set up your trade on the exchange. For this example, let's assume you're trading on a platform like Bybit or with an asset like Ethereum or ETH. After logging into your account, navigate to the trading pair you're interested in and select the appropriate order type: market order for immediate execution or limit order if you're waiting for the price to reach a specific level. Next, enter your position size and leverage, if applicable. Then, set your stop loss and take profit levels. The stop loss is your safety net. It's the price at which you'll automatically exit the trade to prevent further loss if the market moves against you. The take profit level, on the other hand, is where you'll close the trade to lock in your gains. Once your trade is set up, it's essential to monitor it closely. Keep an eye on market conditions and be prepared to adjust your stop loss or take profit levels if necessary. However, avoid the temptation to micromanage your trade. Trust your analysis and strategy and give the trade enough time to play out. In terms of trade duration, this can vary depending on your strategy and the market conditions. Some trades may last only a few minutes, while others might be open for several days or even weeks. The key is to stay flexible and adapt to the market as it evolves. Now that we've covered the basics, let's move on to a more advanced strategy involving the gapped RSI. This is a technique that can provide valuable insights into market trends and help you make more informed trading decisions. The gapped RSI refers to a situation where there is a significant gap between the current RSI value and the previous one, indicating a sudden and sharp change in momentum. This gap can signal the start of a strong trend, or conversely, a potential reversal. It's a powerful tool for traders who want to catch these big moves early. To identify a gapped RSI, start by observing the RSI on your chart. Look for instances where the RSI makes a sudden jump or drop between two periods, creating a visible gap. This gap can occur in either direction, upwards or downwards, and typically suggests that the market is experiencing a surge in buying or selling pressure. Once you've identified a gapped RSI, the next step is to determine how to use this information to your advantage. If the gap is upwards and the RSI is moving towards the overbought territory, which is above 70, it might indicate that the market is entering a strong bullish trend. Conversely, a downward gap with the RSI moving towards the oversold territory below 30 could signal a bearish trend. However, it's important not to rely solely on the gapped RSI when making trading decisions. Instead, use it in conjunction with other indicators and market analysis techniques to confirm the trend. For example, if the gapped RSI suggests a bullish trend, you might also look for confirmation from other indicators, such as moving averages or volume trends before entering a trade. Another way to use the gapped RSI is to watch for potential reversals. If the RSI gap occurs after a prolonged trend, it might indicate that the trend is losing momentum and could reverse. In such cases, consider adjusting your stop loss or taking profit to lock in gains before the reversal happens. Applying the gapped RSI in your trading strategy can give you an edge by providing early signals of significant market movements. However, like all technical indicators, it's not foolproof. It's essential to combine it with other forms of analysis and maintain a disciplined approach to risk management. As we conclude this advanced trading tutorial, let's recap the key points we've covered. First, we discussed the importance of risk management and how maintaining a favorable risk-reward ratio can help you stay profitable, even if you don't win every trade. Remember, trading is a numbers game, and it's your overall performance that matters most. Next, we explored the concept of leverage and its potential to amplify both gains and losses. While leverage can be a powerful tool, it's crucial to use it wisely and always have a clear risk management plan in place. We then walked through the process of setting up and executing a trade, emphasizing the importance of thorough market analysis and disciplined execution. Whether you're trading on Bybit, ETH, or any other platform, these principles remain the same. Finally, we delved into the advanced strategy of using the gapped RSI to identify potential trends and reversals. This indicator can be a valuable addition to your trading toolkit, but it should always be used in combination with other analysis techniques. As you continue your trading journey, remember that success in trading requires patience, discipline, and continuous learning. The strategies and tools we've discussed today are just the beginning. The more you practice and refine your skills, the better you'll become at navigating the markets. Before we wrap up, I want to extend a big thank you to Evan for sharing his expertise with us today. If you found this video helpful, be sure to subscribe to his channel for more in-depth trading content. And as always, thanks for watching. Happy trading.